PagerDuty reported Q2 numbers recently, and they are turning into a bit of a case study into what happens when ARR growth rates decelerate. In Q2 of this year, they posted just 6% ARR growth year over year, adding just 30 million in net new ARR over the last 12 months. Now, if we rewind back to Q2 of 22, things looked really good for these guys. 360 million in ARR, growing at about 34%. They also had 27-month CAC payback and net revenue retention of 126%, right? So nothing to worry about at this point, right? Future looks bright, our metrics are strong, we're on the right path. Fast forward a few years and the wheels have almost entirely fallen off. They spent $203 million on sales and marketing in the last 12 months to generate 30 million in net new ARR. That gave them CAC payback of 96 months over the last 12 months. RPO growth, which is kind of indicative of future revenue growth, was only 5% year over year. And net revenue retention rate has collapsed, right? From the high of 124% in Q2 of 22 down to just 102% in Q2 of this year. There is one silver lining, and that's that they've managed to improve operational efficiency of the business. Free cash flow margins came in at 24% in Q2 this year. That's up from 1% in Q2 of 22. And this was also their first quarter of positive operating income margins. So they generated a 3% operating margin compared to negative 14% a year ago. So it's going to be a tough road ahead for PagerDuty, but at least now with that free cash flow margin and the operating margin in positive territory, they're in control of their own destiny. They're trading at just 3 times Q2 ARR.